Okay. All right, so all right, so let me tell you a little bit about Ferdinand for those who don't know Ferdinand and received this email out of nowhere. No, we got you on our list. So Ferdinand has an immense experience. Now, please mute your microphone. You can mute your
El
microphone.
bultito que usamos para Sammy está chévere con las piezas, con los shapes.
Hello? Eso. Can you guys please mute, señor? Hay alguien por ahí que... Okay. So, Ferdinand has a really incredible experience. Normally, when you find people who are in wealth management, that's most of their experience, right? Maybe some insurance there. When you find people in real estate, it's mostly real estate. And when you talk about raising capital and building companies, like the thing about Ferdinand is that he has a vast experience on all of it, which gives him what I believe is a unique perspective in a lot of things, and the capacity to analyze and foresee things a lot of times even before they happen. How many times Ferdinand said, oh, in the next 6 months, this is gonna happen. People tell him you're crazy. And then that's exactly what happens in the same dates that he said it, right? Like I've seen that happen before. So I love doing live videos and webinars with a lot of people, but when I do them with Ferdinand, I feel like I'm always learning something new, and it's a lot more fulfilling for me. So with that said, I'm going to, hi Carlos, I'm going to continue to be here taking care of everyone who is actually logging in. Again, Ferdinand has an incredible experience, real estate, wealth management, raising capital. He even worked with Nelson Mandela. He worked on the Euro project before it was called the Euro. It was the ECU, the EQ. So you are right now with someone who knows a lot about a lot of things and who is, in my opinion, a huge expert on economy and finance and investment. So I'm going to let you start because I know you have a lot of material and content to share.
Thank you, Juliana. Yes, definitely the content that we're going to have is going to be intense, and I expect to cover a lot of it with information that probably you haven't seen in the media, and probably it's going to have a different perspective in the way we look at things, especially with the data. My objective today is to give everybody a piece of information, very objective analytics, so each one can make their own conclusion. I will give you mine for sure. The first graph that we got is basically to recreate where we at. Right now, we are at a period of time that the yields in fixed income are below inflation. That orange line that you see there is basically the negative rate of return if you own certificates of deposit, treasury bonds, treasury notes, or any investment that has a fixed income into it. So basically inflation right now is eroding the purchasing power of any fixed income investment. And that's what that graph shows. That shows the difference of inflation and the 10-year note. That's why it says real yields. Real, it's interest rate, nominal interest rate minus inflation. Right now it's negative. If you go, Juliana, to the volatility in the global rate hike expectations, you got right now, for example, in this graph, and this, okay, in the volatility in global rate hike expectations, right now, the world is in tightening mode. What means tightening mode? We expect between 6 to 7 hikes of interest rates in the United States. We expect between 4 and 5 hikes of interest rates in European Central Bank, in the Eurozone. And we expect between 5 and 6 hikes in Bank of England. The rest of the world, it's following up. It's following up in hiking rates because the enemy, the number one enemy today, it's inflation. And let me define what inflation is. Inflation, it's the increase of a basket of products that we use, that basically inflation is too much demand, low supply. And that has created too many dollars following too few goods. That increases prices and that erodes your purchasing power. In the next chart, if you look the one in the strong jobs market, there are three things that right now the Fed is really behind it and really looking at it in basically in the way that they want to fight inflation. One is housing. Two is commodity prices, which they don't have control. And third, we have the strong jobs market. Juliana, do you have I think that you got a chart of the strong jobs market that is a powerful support. I just want to show to the people basically how powerful and why the recession that all the press have talked about 2 successive quarters of negative GDP in rice and beans means that the growth of the economy has contracted for the last 2 quarters. But look at this. Usually recessions they have 2 common characteristics: very high unemployment, and usually in the recessions, very low activity, very low demand. What is really very interesting about this chart is that the employment is as healthy as it gets. More people, and you will see another statistics that I'm going to show you later in the presentation. The job market is very strong. And right now, in order to lower inflation, it's very possible that the Fed wants to cause a little bit of unemployment, because in that way, the wage growth, the salaries, right now, for example, the hiring has to decrease because they have to put less pressure into the economy and lower inflationary pressures. For example, right now we're working with $15 per hour. People are paying bonuses to hire. You're going to see in one of the charts that we got more job openings than unemployed people. For any unemployed, you're going to have XYZ amounts of jobs available. So we are in a very robust, very powerful employment market. And like I said at the beginning, remember, the Fed wants to control employment. He wants to lower the employment. He wants to control the energy prices. That's why the government right now releases some of the reserves in order to ease out the supply. And at the same time, the commodities basket is going down, has been going down, and it's trending down. The Goldman Sachs Commodity Research Bureau Index of all commodities. So they are fighting inflation for unemployment. And of course, they want to raise interest rates. And that's causing some of the housing situations that we're going to discuss later on. If you go in the next chart, there is what I call black swan events. Black swan events are events that are not predictable. For example, the Twin Towers, what happened in 2001 with Al Qaeda, that's a black swan event. Nobody expect that. Ukraine is a black swan event. And what has caused the Ukraine event is a disruption in supplies in a lot of commodities: grains, food, oil, gas. And that's really has created a shock in the prices of the commodity index, especially in oil and grains and metals. You are going to see that the reason why a lot of economists are predicting that inflation has peaked is because a lot of the supply chain issues in the distribution and the scarcity with the Ukraine war that caused a lot of these commodities that they spike. Look at the spike of the chart in the right hand. That's going to ease, and there's going to be lower pressures in supply chain. Right now, Congress approved the CHIP Act in order to help with the semiconductors. So there are other things that the government is trying to do in order to contain that price shock that is causing still in the statistics of the CPI, Consumer Price Index, and PPI, an increase and a spike in inflation. In the next chart, it says inflation could get worse before it gets better. The reason why we say that is because the components of inflation, it's food, durable goods, rents in primary residences, energy, transportation services. If you look at energy, which is the gray, you look food, which is the blue, you look rentals, which is the, we can call it a soft blue. Those components, they are still increasing, but they are not increasing at an increasing rate. So I think that picture is gonna get better eventually after the third to the fourth quarter of this year. But in the meanwhile, you're gonna see hot numbers in inflation because the rental market has increased rents in 10%. Food, if you have gone to a restaurant, you can compare your bill of food in a restaurant of almost 35% when you add up tax and you add the tip on the services. So you are having some sticky inflation in those numbers. In the next chart, the yield curve inversion. A lot of people, and I think, Juliana, we discussed this with Cristina Rojas, I think in one program that we did, I think some time ago. We were talking about the inversion of the yield curve, and she was really worried in that program about that. Well, the reason why she was very worried about it is because in the last, since 1965, let me explain what is an inversion of the yield curve. Yield curves are interest rates and duration. Short-term maturity treasuries should have a lower yield than longer-term duration bonds, because usually you should get paid more if you hold your money for more time, right? The inversion means that interest rates in the short end of the curve, it's higher than the longer term. And since 1965, every time that event happens, a recession happens 12 to 16 months after that inversion. As we speak today, I have Bloomberg television in my left, you don't see it. Right now, I see that inversion has already been sticky for the last 2 weeks. In this graph, you don't see it yet, but you can be association of recessions in year 2000 when the inversion is negative. You can see in 2007, 2008, before the crisis. I don't expect a crisis, by the way, but just to let you know that I'd anticipate 12 months before the crisis. And now that line, it's almost at the same level than 2006, 2007. And really, it's in if you compare the bond, it's around 2.80, around 3.10, 2.80. So it's a negative difference. The short end has a higher interest rate than the 10-year note by 35 basis points. So that line is already negative and the yield curve is inverted. And that's something that you gotta pay attention to it if that really sticks going forward. If you go to the next chart, one of the tools that the Fed has in order to lower demand is to tighten the balance sheet. It means that it won't be the last buyer, the last resort, the backstop of the banks to buy the bonds of the mortgage paper that they issue. One of the ways to control inflation is control supply. And one of the ways that you can control supply is that you don't become the last resource to buy the paper or the mortgage paper. And that's one way to create liquidity constraints and lower some type of demand. If you see the chart, we were in the stratosphere when COVID happened. The market, the central bank panicked, just completely panicked. Janet Yellen says, let's go big before we get a depression. We deal with inflation later. She said that. She was quoted on that. Let's go big. Let's supply the market whatever it needs. Put a lot of liquidity. We will deal with it after the fact. But we have to avoid deflation. And that's exactly what the market got. Now we got inflation. We got an excess liquidity that now we have to dry up the system. And that's why I think that you got to take a particular attention in the quantitative tightening that it's coming from the Fed, lowering the liquidity in the market. The next chart is one of the Julianas, and people have asked me about confidence, consumer confidence. Everything in the economy, 62 to 63% of the economy runs in confidence, in consumption, in demand of products. Right now, I will tell you that I will follow more the University of Michigan consumer sentiment. Right now, we're going down and going down hard. Right now, the consumer confidence in Michigan is around 52. It's lower than that chart. It has really deteriorated in the last 2 months. And that is something that we have to take a look at it. In the next chart, that has impacted. Basically, this is a no, go ahead before that. Yeah, it's important because this is a Real Deal. Real Deal is an important magazine for private equity guys like me or real estate developers in New York and developers in the real estate area. This is a quote that I got on June 2022. Let me tell you what it says. Buyer sentiment suggests bad buys. A recent Fannie Mae survey found only 24% of consumers believe it's a good time to buy a home, with similar leaves of pessimism expressed by nearly all of the demographic groups surveyed. It's pretty much the definition of a market failure. If 3 or 4 buyers of any product feel bad about their choice, yet it's still the only product they can buy. That's exactly what is happening, and that's one of the goals that the Fed is getting success. It's really diminishing the housing, and we will talk about that later on. What is the status on that housing and the stats in general? But definitely consumer confidence, it's really going down. The next chart, Juliana and participants in this webinar, I just want to let you know that the Fed, his target in inflation is around 2%. 2% basically, it's the inflation rate that basically the Fed is trying to get the inflation lower. And that target right now, based on the numbers of inflation, it really has become a very problematic situation because the long-term target of 2%, right now we are way ahead. Look at that black line, has jumped in 2001, 2021, because all the liquidity of COVID, of all the expansion in monetary supply to avoid depression, really cost a lot of money chasing few goods. And that amount of liquidity is running inflation in a very high level. It ran almost to 8 to 9%. I didn't include in this webinar a chart that I have about inflation, because there is the real numbers of inflation are much higher, by the way, than the ones that provide the core PCE inflation and CPI by a fact, okay? Around 3 to 4 points ahead of what really they report in the CPI. Now, if you go to the next chart, you will see that we are bracing for a rate hike cycle, which, in my opinion, it's going to last until next year. The projection that we have is in the Fed funds rate. Right now, the Fed funds rate is running around 2.25. We expect to hit it in the next meeting in September to 2.75, probably 3%. But the projection based on the 7 hikes that we expect, that probably we're going to hit between 3.5% to 3.75% when everything is said and done. And I will tell you later what will mean for mortgage rates and basically fixed income investments in the future. In the next chart, I just want to go tell you one thing that the market knows. 9 times since 1961, the central bank has embarked on a series of interest rate increases in order to lower the inflation. 8 times of 9, a recession has followed. 1961, 1971, 1974, 1981, 1990, 91, 2000, 2001, 2007, 2009. And now we are facing the mini recession in 2021 by COVID. So basically, in 2020. So basically, of 9 times that we got into a central bank has embarked in a series of tightening cycles. Of the 9 times, 8 has become basically in recessions at the end. In the next chart, historically, one of the things that we have found is that people are asked, well, what do you do in a scenario where you got inflationary pressures, and what the research has shown in the most successful money managers, institutions, and endowment funds in the United States, what they're doing or what they do when they have some type of a different cycle, a tightening cycle. The question and the answer is in the next chart. We got the Harvard Endowment Fund. Basically, the Harvard Endowment Fund, if you look at the way that they distribute their assets, it's very interesting. 22%, they invested in real assets. Real assets are commodities, they are real estate, multifamily. Around 18 to 50, around 15%, they invested in alternative investments. It means that they call it hedge funds. Then another 12% they invested in private equity, which is investment in private companies. So when you add up 12, 15, and 22, that gives you around 49% of their assets are not stock market correlated. They are not bond related. They are not financial assets correlated. Look at how much of the investment has been invested in different assets, what I call the traditional versus the non-traditional. If you go into the next chart, you're going to look at the studies of the inflation hedge, which is basically how the real assets have really compared with the tried and the true inflation hedge. Here, you can see that commodities, infrastructure investments, real estate, they have been positive in inflation. They have a high beta to inflation. It means that they are highly correlated to inflation. The same thing happens, the outperformance in years when you invest in real assets, real estate, infrastructure, and commodities. Look the orange bar in rates of return after inflation versus the gray lines, which is our US bonds, US equities, and of course, money market rates, which are in the lower strata. In the next chart, you're going to see the real estate performance and the reason why they do better in inflationary periods. And it's because the rents go up. Right now, rents are going up at a rate of 10 to 12% in many areas. Besides the whole situation with the housing, besides this whole situation of the affordability of new homes, basically people have to live somewhere, and they usually were seeing a increase in cash flowing and a lot of income properties. We got higher occupancy rates. We're seeing stronger rent growth in all areas in the United States. Probably the Northwest is the one that is a soft area right now. And that has produced better cap rates, better income multipliers for appraisals of multifamily or rental homes, or what is called build to rent. In the next chart, you're gonna see that real estate, because of that of that characteristics, that they can increase rents. Look at the rates of return in moderate inflation, how they compare real estate investment trusts against the S&P 500. In moderate inflation, they outnumber the rate of return. It's better in moderate inflation, and even in high inflation, like we are right now, because of the increase of rental. Look at what is the effect in rates of return versus the S&P 500, which is basically stocks. So in high and moderate inflation, real estate is a better performer than financial assets like bonds and stocks. Of course, in low inflation is the opposite. Stocks and bonds outpace the real estate investment. In the next chart, I'm going to explain why we're so bullish in Florida. And I'm going to go very fast on this one because these are statistics that you should take a look at it. In the next one, Juliana, they are in Florida. The reason why Florida is so important is that 2 of the 10 counties that saw the greatest population growth last year were in Florida, according to new data released by the U.S. Census Bureau. Polk and Lee counties gained the most residents last year, while 4 of the top 10 metro areas that reported the greatest population growth by percentage were in Florida. Punta Gorda, where I will be heading after I finish this webinar. I will be there in Port Charlotte, Punta Gorda. We got some appointments there. The villages in Lakeland, Winter Haven, and Cape Coral, which I will be tomorrow, and in Fort Myers on Friday. Most of the inflow of people moving into Florida come from northern states due to weather, and another large group from states that have estate taxes. Florida is a property tax only state. The next chart, it will show you what Redfin, which is a think tank in real estate, is saying. They made a research, which I incorporated. This was not part of the first seminar, Julian. This is a new statistics that I got in the last couple of weeks. And I thought it was very interesting. According to Redfin, here are 10 cities people are moving from. So it means that people are getting out. San Francisco, Los Angeles, New York, Washington, Seattle, Boston, Detroit, Denver, Chicago, and Minneapolis. There is a common element in these areas. Outside of San Francisco and Los Angeles, I would say that there's cold weather and high taxes. In all of these 10, they have high taxes. And in 8 of the 10, cold weather. Now, the next slide, let me show you what are the people are moving to. They are moving to Miami. They are moving to Tampa. They are moving to Phoenix. They are moving to Sacramento. They are moving to Vegas. They are moving to Cape Coral. They are moving to San Diego. They're moving to Northport. And they're moving to San Antonio and Dallas. 4 of the top 10, they are in Florida. And of the 4 in Florida, 3 are in the Southwest, where I think I am most bullish in resisting any increase in housing or interest rates. In the next chart, I will show you the demographics of where we are and where these people are coming from. In Miami, 31.8% come from New York. In Phoenix, they come from LA, of high cost of living, high taxes. In Tampa, they come, believe it or not, this is a very interesting statistic. They come from Orlando and New York because they're moving from more expensive cities to cheaper cities, and they're close by. Sacramento, San Francisco, and Seattle, Vegas, they come from LA, Cape Coral, Midwest, Chicago, and Northport, Chicago, and a lot of Midwest, Wisconsin, and Minnesota because of the cold weather. Let me show you the statistics of some of these. And this is a Lee County, by the way, in Southwest Florida. This is the next chart. This is the market statistics as of June of this year. Single family homes, you got the statistics in 2021 and you got the statistics in 2022. Like I say, these are statistics until June 6, 2022. Already 3 hikes in the Fed, okay? Look at I just want you to take a look at inventory. Look at that. It has a reduction of 30% of new homes available in that area. Look at the days in the market. Days on the market, it was 26 days. Now it's 18 days. That area has pretty much like 1 month. 1 month of inventory, when United States, the average inventory is around 3 to 5 months of available inventory. This area have only 18 days in the market and only 1 month of inventory. So the supply is very low and a very high demand. If you go to the next chart,
Catherine, I believe you have your, can you mute your microphone? I'm sorry. Thank you.
In the next chart, some of the people say, well, how I can participate in something like this, but I can have some control and I can own some of a piece of investment in these areas which I don't know, but you know. But at the same time, I can get a participation of a minimum rate of return and participate in the growth of these statistics that we don't see it coming down too much or too soon. In the next chart, there is an analysis and a creation that we did. It's called the Preferred Lending Agreement and Real Estate Joint Venture. That is kind of the inspiration of the Harvard Endowment, that you add real assets, tangible assets. So basically the type of agreement includes the new construction of property that we do for people as a direct collateral of the capital investment. The alternative guarantees through the first position lien against the property in favor of the investor. And the preferred lender agreement pays a 6% fix, which is double of what you're getting right now in a fixed income alternative. And at the end of the construction, the agreement has the option to convert it into a joint venture so that the investor can participate in the profits of the sale of the property. That's unique. That is unique. And it's one of the things that we have really built for security and give a participation to our people. And we offer it through a lot of different systems and models. But this is one example of how Harvard and the endowment funds invest their funds. They do a lot of joint ventures. They do first position as a mortgage in the property. So in case of the worst case scenario, they can get some higher return. And that's basically one of the ideas that I want to introduce in this webinar. The next one is very interesting. It's really the expression of what I mentioned at the beginning. Look at the amount of liquidity that we have right now. $5.8 trillion. I repeat, $5.8 trillion are in money market funds and saving deposits. That's why it doesn't feel like a recession. If you go to a restaurant right now in Miami, it's packed. You have to make reservations 24, 48 hours before you go there. If not, you're not gonna find a seat until 10 o'clock at night. People have money. They have a lot of liquidity and they are absorbing the price shock. The big question is, for how long? The next chart is important because really it's one of the things that I've been telling a lot of the people. Yes, the reason why we don't believe we are in a housing bubble is because Fannie Mae, this is what Fannie Mae says, it's not Ferdinand, it's not private equity, it's the government. I will read it, I will read it for you. Fannie Mae says, housing crisis will last a decade. Recession or not, the US doesn't have enough entry-level homes for everyone who needs one. And it will take at least 10 years for supply to catch up with demand. In the next chart, I will show you what CoreLogix, which is one of the best statistics of housing you can see. I will show you what is the risk, why we're so bullish in Florida. What is the risk by states of decreasing pretty much home prices, the possibility of home prices dropping, and the odds of regional home prices dropping in the system. CoreLogix did a study by percentages. It has very low, it has low, it has medium, it has high and elevated. So in that one, if you can show it, Juliana, in that chart, it says markets at risk. We like to go to the data of the people that they can provide us. What are the chances of dropping prices of homes by region? And look at what we have found out. The whole state of Florida is in a very low chance of dropping prices because of the high demand. There are three main factors: lower taxes, quality of living, and the weather. And at the same time, Florida has something that not other states has, is that the instability in the South American and Central American governments, it's pushing a lot of wealthy and institutional money to come to United States, and the place that they put it is in Miami, Tampa, Orlando, and areas where the culture is pretty much very friendly for Hispanic Americans. And that's a factor that is not included in a lot of statistics. In the next chart, I want to show you that there are some type of financing that not necessarily goes with the mortgage rates in FHA, and it's the conventional market. Look at if you have a down payment, which usually that's what we have seen in the area of Cape Coral. 35% of the purchases are without banks because they have money. But usually if you have a down payment of 20% and you have a purchase price of $600,000 and you have a credit score of 740 plus, you can find some competitive rates. And I believe that when you compare the rents increases that you have right now in a similar home versus financing, you can find options. And I believe that what happened is that the newcomers are the ones that are getting affected by the increases of rates and with the lower payments and lower credit scores. Those with the increasing rates, no question about it. A lot of the millennials, the 25 million millennials coming to the market, I will tell you that probably between 35, 40%, they are no longer candidates to buy a home for the time being. But they're coming good news, and I will show you later why there's coming good news coming up in the future. In the next chart, I just want to show you that everybody mentions that it's so high, that this is an unbelievable amount of rates and all that. Not necessarily. The average mortgage rate in the last 20 years, 30 years, has been 7%. That has been the average. From the top of 17% in the year 1981 to the lowest, which was around 2020, that was almost zero. Look at the chart. Basically, if you look at trend, the average trend is around 7.5, 8%. That's the average mortgage rate. And people, they keep buying homes. That didn't stop them to buy homes, even at 18%. So, you know, they make a big thing because we're coming from a zero cost money environment, which was not sustainable. But we're not going to come too much. You will see my prediction at the end. that basically we're going to come something very reasonable. And like I say, there's still some rates available and some options for the people to buy homes still. And I think that the low supply is going to somewhat has a counter effect against any major decline in the housing market. For example, that's the next chart. You're going to see that adjustable rate mortgages are coming in a vengeance. You're getting pretty much the strategy here will be that since the Fed always pushes us to a recession and eventually the rates are going to come down, that if you can have an adjustable rate mortgage now, which has a lower rate, probably you're going to get a possibility of refinancing in the next 18 months. And you can probably get a fixed rate similar to the adjustable rate mortgage today. And probably you can get a better deal and getting into your home, because in my opinion, we're going to have an increase in homes between 5 to 7% in many areas, especially here in Florida. Even if you are thinking in waiting, think twice, because I think that prices are not going to come down that much. In the next chart, I summarize pretty much what are the main factors happening with the market. And that's why I think we are not going to have a real estate crash. There is a lack of supply. Fannie Mae confirmed that information. We got a strong demand. We have accumulated huge amounts of accumulation of savings. We have a strong job market. We have better debt income levels. This is the best balance sheet that we have seen the consumer in the last 20 years. I didn't say that. That was Bank of America, JP Morgan, Visa, MasterCard, American Express, all express that they have solid numbers in their quarterly earnings. And the main thing is COVID changed our lives. It changed the way to see work. It changed in the way that we build homes. In the next chart, basically, there is a major demographic and a major generation change. And is that we are seeing baby boomers liquidating their home equity, converting in 1031 exchanges, buying a couple of properties, and at the same time, they want to rent one of the units and they want to live without any debt with the other unit. The other thing is that we're seeing the introduction of millennials. Millennials now, they're becoming parents, and they're becoming now, instead of having the dog and an apartment and a girlfriend, now there's a wife and a kid, and now they're changing their perspective. The next slide, basically, I'm going to be very quick on that. Juliana, basically, I just want to show you that America, this is a Wall Street Journal. America still needs more homes. Housing slowdown is only exacerbating the market's biggest problem. There are not enough homes. In the next chart, you will see what the smart money like Blackstone is doing. They're putting the last touches on the largest real estate fund ever in the United States. It's going to be a huge $30.3 billion buying housing for rent and multi-family. It's going to become a mammoth of real estate. Do you think that Blackstone will buy $30.3 billion knowing that the market is going to collapse? I don't think so. The next chart basically is very interesting. This is the ratio of job openings to unemployed people. We have right now, 2022, the best ratio of available work since we have these statistics. 2012, 0.3. The best statistic was 1.2. We are in 1.9. For every unemployed, we got 2 more jobs available to work. That's a very strong labor market. In the next chart, I just want to show you that I think inflation is starting to peak. This is a chart of gold. Milton Friedman, a lot of the economists, they always say that gold is the ultimate hedge against inflation. So very basic. If it's the ultimate hedge against inflation, don't you think that the price of gold should be up today? No. It has violated the 200-day moving average and it's coming down. Today it's down again in 1700. So that tells me that the market is perceiving that inflation has peaked and probably it's coming down in the future. And that's why yields in bonds are dropping as of today. And the next chart that I have for you in this one, I think, Juliana, it's the home builders, which are one of the main industries. Look at what is happening. Gold is dropping and home builders is starting to pick up. That tells me from the market perspective that things are starting to change and the perception has started. Look at that they violated the 200-day moving average in February of 2022, perceiving that inflation and interest rates were going to come up. The markets are smarter than a lot of the Federal Reserve governors. They anticipate. The Federal Reserve just confirms, but does not anticipate. The job of the Fed is not anticipation, it's confirmation. Markets anticipate. That's why I follow more the markets than what the Federal Reserve talk. And right now, the market's telling me that inflation probably is coming down and home builders are starting to recover. In the next chart, well, like I said, basically we got some future strategies. We got lease to own in case of a major situation that we can have probably. We have techniques like owner financing with no prepayment penalty. All these techniques that you have there, if market's sour, you see the lemons there, we're prepared. That's our specialty. That's how we create private equity in 2009. In the middle of the crisis, we did owner financing. We did rent to buy when everybody was not talking about that. We did lease to own. We did rent to build to rent. We did all these things. We did some first liens, senior lien paper to help a commercial property. So these are just in case we are prepared. We got the Swiss knife ready, and we got the techniques to deal if we get a crisis in the housing or real estate market. Now, the last 10 minutes, I put together some of the things that they have asked me about the stock market. And in this chart, which is upside down, which it's okay, we change it, it's fine. This is the analysis of the stock market. Everybody has talked to me about the stock market. What do you think about the stock market? Well, the stock market, basically, this is a natural cycle forecast that we did in the programa El Juego Financiero that we do at WEAC 740, 740 in Puerto Rico. We do it from 12 to 1 o'clock, and Juliana always put the broadcast in the newsletter of Lion Burn and private equity. But basically, this is a forecast that we did in January 2022. This was provided by one of the best analysts ever, Larry Williams. I have subscribed to his service. I pay for his forecast every year. And this is what it came out. Guess what? It has been fairly accurate. He predicted in January a big decline, a recovery, a downtrend, and right now he's predicting in the fourth quarter, between September and October, between the midterm elections and the first half of the fourth quarter, a major rally. If that rally is anticipated because probably the Fed is going to start probably lowering the intensity of the interest rate hikes, we don't know. It's because probably it's going to be a change in government. I don't know. But basically, if we look at it statistically, it seems to me like the fourth quarter It's something that you can take a look at it. The next chart will tell you that when there is an election and we got the years of every year number 2 in the decennial pattern, it means 2000, 1952, 1962, 1972, 1982, 1992, 2002, 2012. The prediction coincides with a big spike in the fourth quarter. Fourth quarter means September 30th to the first part of 2023. So that tells me something, and that tells me something about the whole situation with the interest rates. In the next chart, it's very important because I know a lot of people, they have been clobbering the market, or they have been suffering with the whole situation with the interest rate hike and the volatility of the markets. Basically, in the next chart, you're going to see what happened when the markets corrected so badly in the last 11 bear markets. Bear market is called when you got a decline of 20% plus, and it's cyclical. We got 1957, 1961, 1966, 1968, and so far, so on. The market has declined 27.38. This year, the market has declined in the bottom almost 23%. So we are almost there. Look at the recovery 1 year later. Look at the recovery 6 months later. The market doesn't wait. Probably when you are in a recession, already the market already factored those bad news already. And I think that that's the case in this market. The cycle analysis and the statistics show me that basically we are in this early stages probably of a new bull market. I know it sounds crazy. I know a lot of people say this guy smoked something today. No, I didn't. I basically follow the trends. I follow the statistics, and I will show you why. Go to the next chart, Juliana, because it's very important. I'm finishing up. I'm going to be on time.
Yes, I'm sorry. I'm just answering some of the questions we're having on the chat. They're asking us where they can find the radio show. So yes.
Oh, okay. No, that's fine.
I'll answer.
2009. I'm going to be very quick on it. I just want you, this is a visual practice. A lot of what I do, I check charts during the week, hundreds of charts. I just want you to take a look, 2009, look the shape, look the decline, look what happened in 12 months. Juliana, I want the next chart. It's the September 2016. Guess what? Doesn't look similar? Big drop, big decline, 2 drops. Whoops, it goes up. Let me show you another graph, 2019. Big drop, twice, goes up. Let me go show you another chart, 2020, another one. A big drop, retest, off to the races. The next chart shows you, if you want to really time the market, the best is the third quarter. Look at the statistics. In worse years or best years, the third quarter has been the laggard in performance in the markets. Even in the best years, the third quarter is the worst performer if you compare with the other quarters. First quarter, 44%. Second quarter, 40.64. Look at the third quarter, 18.76 in the best years. Now, when you look at the green, which is the worst years, is the opposite. The second half of the statistics. And you're going to say, what is the second half? Well, the second half is right now. It's August, September, because the third quarter finishes in September the 30th. So right now, on a seasonality basis, I will put somewhat of someone that wants to get into the market. Probably the market right now is rallying today. It's an intermediate trend, but I won't put all my eggs in immediately. I will probably wait to see what happened until September the 30th and the elections of the midterm congressional elections. But look at what happened in the fourth quarter, off to the races. So basically, a good timing mechanism is to wait a little bit, be cautious, probably chip in, get in a little bit, start to dollar cost average, get some of the good stocks that you like now, and probably wait a little bit for the fourth quarter and get for the gusto. Because that's exactly what is happening for the last 11 bear markets that we have. And the last charts that I show you shows that the market does not wait for anyone, anticipates the thing. I want to show you the last three charts, and that's it. I will be over. The last three charts, it's the current market. And I will show you that for the first time last week, we had a buy signal. That's the green light right there. After a huge decline, this is this year, this is 2022. This is a chart until Friday last week. We had a breakout. Technically, it says that the worst is over. I'm not telling you that probably we can go down a little bit because of the third quarter, but probably the worst is over. And case in point, let me show you two last charts. The next one, Juliana, it's the one that is the volatility in. Okay, leave it there. Leave it there. It's very interesting when I mention in the Juego Financiero in the program, don't listen to the media. I'm not trying to be disrespectful. Just follow the actions of the big money. Let me show you, this is the market this year. You see a huge drop, and there is a line in the bottom of that chart that it's called accumulation distribution. That is an indicator that measures the activity of the market between 2 o'clock and 4 o'clock of every day. Guess who are the buyers and sellers in the last 2 hours of the trading day? The smart money, the Morgan Stanley, the Goldman Sachs, the Merrill Lynch of the world, and the trading desk. Look that chart again. A lot of these firms are saying that we're going to hell. Well, I don't think so. They're not doing that. They're buying the market. They're buying when you are selling a scare. Look at what they're doing at between 2 o'clock and 4 o'clock in the afternoon. They're buying your shares that you panic. They're buying the apples at 125. They're loading up in Microsoft at 247. So don't just get the facts, get the statistics, don't listen to the press. And that's the end of the webinar.
Well,
I hate it, Juliana. I missed by only 1 minute, okay?
I think it was really good because you covered real estate and the stock market, and most people don't cover everything. So I think it helps a lot of the people who are live here today with us correlate, right? What's going on and how each affect each other, right? And again, you said it very well. Be careful with listening to the media. They need to sell headlines, and they need to make sure that you keep clicking on their newspaper website and so on, right? And what we need to look is into data that is a lot more complex and what the big guys are doing. So I think that was really good. I know some people just jumped in right now. So if anyone has questions, we do answer questions in English or Spanish. Okay, so whichever language you feel more comfortable with, please either leave it on the chat box. If you don't find the chat box, then you can do it by voice. It's fine. I just don't want everyone at the same time to be asking the questions. Thanks, Ivan. They're sending direct messages through private to me. Thank you so much. Yes, I'll send you everything, okay, for those shows. So if anyone has any questions, we have right now about 20 people logged in. So if anyone has any questions, please feel free to ask them, whether it's real estate.
It can be, Juliana, any technical terms that probably people say, I got lost when you mentioned XYZ, and
Yeah.
I cannot change, you know, with the content. If you need an explanation, I will be more than glad to go and try to explain in rice and beans as much as I can.
Yeah, and also we know that some people logged in halfway through it, so it's fine if you ask something that we already spoke about, because most likely, you know, there's people who were in for the first 30 minutes and others that joined in the last 30 minutes. So thank you, Mariela. Yes. Oh, I saw someone.
¿Dónde estás?
Hola, Frances.
Sí,
Hola, Frances.
Sí.
¿Sí?
Nada, pues se me ha mandado un link.
Voy a mandar un link, pero ¿de qué es? ¿De su casa o de la radio o de qué?
Está en una especie de videoconferencia pública y tal. ¿no?
Frances, te estamos escuchando. No sé si tienes alguna pregunta. Hola, Frances. Frances Badía. Nos puso mute y se puso el altavoz. Hello?
I know, it's fine.
Okay, so I think I don't see any more questions here. Again, like if anyone has questions, I thank you everyone for connecting. I see a lot of familiar names, but I also see some non-familiar names. And I see Roxana from El Diario La Prensa. Thank you, Roxana. Sharonese is saying great presentation. Thank you. Also, Mariela Nieto was saying thank you so much for the great presentation. Excellent. Ivan Ochoa. Roxana, thank you for connecting too. I know you have a busy day between press releases and everything. So if anything helps you. Natalia, oh yes, Natalia, she logged in last minute. So she's asking if we can send the presentation. We'll send you a link to the video, okay? Because we are recording everything. So
the only thing that I will add, Juliana, just to complete all the charts, can you go to this one before this one, just to go over it because it's very important. You got another one there. It's called the volatility index, or you didn't have that one?
Hold on.
Okay, no problem. No problem with that. We cover everything then. We cover everything. Let me see.
Oh, okay, because you have a lot of
yeah, that's fine. That's no,
okay.
The reason that I mention is just in case that people, they ask me, what about what I think about there is an indicator called the volatility index. The volatility index is an index that is used, Juliana, and participants for measure fear, to measure how many people are buying protection because they believe that it's the end of the world. And usually institutions use hedging. So that chart, I have it. It breaks down last week. It tells that a lot of people are just getting out of the protection and they're starting to start buying what I mentioned in the last chart. They're starting to buy, and in some institutions, they think they're preparing for that fourth quarter, just to let you know that.
Okay, perfect. Well, thank you so much.
Okay.
Everyone will receive the video of the last of the presentation. So in case you missed some pieces, you can go over it again. Again, feel free to send us any emails or whatever with your questions. We do speak English and Spanish. Ferdinand speaks English and Spanish. He's the one answering. I'm just here to help out. So you'll be able to get any answers that you need to your questions. Okay, so Francesc is always on all of our videos. I'm so surprised he doesn't have a question today though.
Sí, estuve aquí, pero como aprovechaba que estoy con mi hija, pues ya en la...
Oh.
All right, so we'll send you the video in case you have more questions. Okay.
Pero estuvo muy bueno.
Me alegro.
Claro que sí.
Que tengan una feliz semana y les mantendremos al tanto.
Muchísimas gracias. Nos vemos pronto. Chao.